Topic 5, Deferred Tax MFRS 112, Part 1. Okay, for this part, we are going to cover 3 learning objectives. Okay, there are to identify differences between accounting profits and taxable profit. Second, to describe a temporary difference that result in future taxable amount and future deductible amount. And the third one, to partly explain the computation of deferred tax. As you know or aware, in Malaysia, all companies are required to compute their tax payable and pay income tax, if any, to the Inland Board Revenue (IRB) or Lembaga Hasil Dalam Negeri (LHDN). Right, income tax has been an accounting issue due to difference in accounting standards or rule versus tax rule in determining the taxable income. Income tax payable is calculated based upon tax regulations. However, income tax expense that is presented on the financial statement or for accounting purpose is calculated based on accounting standards of IFRS or MFRS. So the differences between tax rules versus accounting standard cause the income tax payable amount often differs from income tax expense that shown in financial statement. Example of differences between the two sets of rules. First, capital allowance or depreciation rates. Under tax rule, the capital allowance or depreciation rate is based on rule of rate sets by IRB. However, for accounting rule, it's based on GAAP. For example, MFRS 116 for PPE. Second example is leasehold property. Under tax rule, this kind of assets is not qualified for allowance. However, under accounting rules, it must be depreciated. The third item are revenue or expenses. Under tax rule, it's recognized under cash basis. However, for accounting rule, they are recognized based on accrual basis. The last example here is entertainment expense, which is not allowed as deductible expense for under tax rule. However, for accounting rule, it can be recognized as expense and deducted from profit. So these differences results in differences between income tax payable and income tax expense. Right, there are two types of differences in general. The first one is temporary differences and the second one is permanent differences. So what are they? Temporary differences arise when in computing tax payable, certain expenses may not be allowable deductions and certain incomes are not taxable, both in the current periods. However, they may be deductible or taxable in the next or following periods. Examples of items that cause temporary differences are: a tax rule only allows expenses that have been paid, but accounting principle allows accrual expense. For example, interest expense is recognized on accrual basis, but for tax purpose, only interest that is paid will be allowable as an expense. B. Tax rule tax receipts when cash is received, cash basis, but accounting standard or principle is to recognize it as an income when it is earned, accrual basis. C. Writing off expense or capitalizing it as an asset. For example, for tax purpose, research and development expenditure are allowed as deductible expense in the year they are incurred. However, under the accounting treatment, MFRS 138, research expenses will be write off or have to be written off immediately. And development costs may be capitalized if the capitalization criteria or conditions are met. D, due to different quantum of expense. Depreciation, for example, depreciation is charged as expense based on the economic life and other factors related to the asset. Versus tax rules, as I've explained earlier, have a uniform rate of capital allowance which is different or may differ from entities' depreciation rate. The second types of differences is permanent differences. It refers to items that are not allowable for tax purpose, such as A. Donation to unapproved charities. B. Entertainment expenses. C. Penalties and fines. D. Dismantling and decommissioning costs. And E. Interest revenue from government bond that is tax exempted. The company business entity will deduct or add these items to arrive at the accounting profit, but the tax authorities will disallow them. Hence, permanent differences are ignored. For deferred tax accounting is not being covered for deferred tax accounting purpose. So our focus is on temporary differences. A temporary difference is the difference between the tax base of an asset or liability and its carrying amount in the financial statements. The difference between these two bases will result in taxable amounts or deductible amounts in future years. Right, there are two types of temporary differences. First one is future taxable amounts or taxable temporary difference, TTD. The second one is future deductible amounts or deductible temporary difference, DTD. So if a company has TTD or taxable temporary difference existing at the end of the current year, it means that they will have to record or recognize deferred tax liability that represent an increase in tax payable in future years. However, if an entity have DTD, deductible temporary difference, existing at the end of the current year, it means that the company has to recognize deferred tax asset or will recognize deferred tax asset that represent an increase in tax refundable or saved in future years. Alright, deferred tax. The following example illustrate how a difference in tax payable and tax expense arise. Assuming in year 2018, XYZ company recorded an impairment of accounts receivable of 10,000 ringgit Malaysia, and this impairment was not considered as a deductible expense. According to the tax laws, this impairment can be considered as a deductible expense in year 2019, which is the following year. Assuming that the profit before tax for 2018 is 500k and income tax rate is 25. For tax expense, the company will multiply profit before tax 500k with the tax rate 25%. So the tax band is equal to 125k. Meanwhile, for tax payable, okay, the company has to adjust first the profit before tax by adding back the impairment of the account receivable. So the revised taxable profit is equal to 510,000. Therefore, okay, the tax payable, okay, will be a bit higher as compared to tax band, which is 127,500. Okay, the difference of 2,500. Is that difference accounted for in the financial statements? Yes. The difference between income tax expense and income tax payable, Rm 2,500, is a deferred tax amount. In this case, it is a deferred tax asset, where tax will be lower in the future. So the entry at the end of 2018 to record the income tax will be as follows. The company will debit income tax expense, 125k, credit income tax payable, 127,500, and the difference is debit deferred tax asset, 2,500. Alright, let's move to the next illustration, okay, in which, okay, still in 2018, okay, assuming that an entity had recognized interest receivable on its fixed deposits, Rm 200 and 2,500 as its income. Interest income, okay, under tax rule is or will be taxed when received. Right, then we assume that the pre-tax financial profit is 300,000 and the tax rate is 25%. Therefore, for this particular year, the tax expense for this company is equal to profit before tax multiplied with the tax rate, okay, which is equal to Rm 75k. However, for tax payable, okay, before we can calculate the amount of tax payable, we have to adjust the profit before tax first, in which we have to deduct the interest income, as it is not taxed yet or subject to tax in 2018. Therefore, okay, the taxable profit will be lower than the profit before tax, and when we multiply with the tax rates, okay, of course the tax payable will also be lower, okay, which is only 74,375. So the difference between income tax expense and income tax payable in 2018 is Rm 625 ringgits. This amount represents tax that the company will need to pay in future periods. For this case, okay, the difference is a deferred tax liability. Okay, the entry that will be recorded to record the income tax is as follows. We're gonna debit income tax expense 75k. We're gonna credit income tax payable 74375, and the difference, okay, on the credit side is deferred tax liability 625. Okay, now on the computation of deferred tax. MFRS 112 requires entities to compute deferred tax based on financial positions, or generally referred to as the liability method or balance sheet method. Under this method, temporary differences are differences between the carrying amount of assets and liabilities in the financial statements versus the tax base of the assets or liabilities. Tax base is the carrying amount for an assets or liability for tax purpose. This table summarizes the differences between carrying amount of value and tax base for assets and liability. Okay. The first, as we can see in the first row, okay, if carrying value or amount of an assets is higher than its tax base, okay, what we're gonna have is taxable temporary difference, TTD, which represents amount of tax that need to be paid in the future. So we're going to record credit side deferred tax liability. Okay, in contrast, okay, if the carrying amount of the asset, okay, is less than the tax base, okay, what we're going to have is deductible temporary difference, or DTD, okay, that represent deductible tax amount in future. So for this case, we're going to record on debit side deferred tax assets. Okay, the last two column, okay, is for liability. Right, the last two rows, okay. For the third rows, okay, liability, if the carrying value is higher than the tax base, okay, what we're going to have is deductible temporary difference, DTD, okay, in which the company will need to or will have deductible tax amount in future. And for this scenario, we're going to debit deferred tax asset. However, if the carrying amount of a liability is less than its tax base, okay, what we're going to have is a taxable temporary difference, TTD. For this case, we're going to credit deferred tax liability. Alright, steps to calculate deferred tax. There are 3 steps. First is to identify any temporary difference. Second, determine whether the temporary difference is a taxable temporary difference, TTD, or deductible temporary difference, DTD. And the final step is to calculate deferred tax liability or deferred tax asset. Alright, we have here several illustrations, okay, for step 1, and to identify temporary difference. A. An entity has a plant costing Rm 100,000, on which 20,000 depreciation has been charged. Meanwhile, the capital allowance tax depreciation claim is 50%. So how much is the carrying amount and tax base of this plant, and how much is the temporary difference? The carrying amount for this plant is Rm 80,000, in which we deduct 100k the cost with the depreciation. Meanwhile, the tax base is just 50,000. Okay, when we deduct 100k of the cost with the capital allowance claim. Therefore, the temporary difference for this asset is 30,000. Right, next, B. An entity, okay, has capitalized development cost with a carrying value of Rm 14,200. Okay, for tax rule, okay, it allows development costs to be expensed when incurred rather than capitalizing the carrying amount. Right, so how much is the carrying amount and tax base of the assets, and how much is the temporary difference? Right, the carrying amount for this asset is Rm 14,200. Meanwhile, the tax base is nil, 0, as the development expenditure is deductible for tax purpose when incurred. Therefore, the temporary differences for this asset is 14,200. C. An entity took out a 10% around 4 million loan on 1st January 2018. Interest on the loan is paid every 12 months in arrears. Right, so how much is the carrying amount and tax paid for this loan? Okay, and its interest accrued. And how much is the temporary difference? Right, the carrying amount of the loan is around 4 million, and for the accrued interest, the carrying amount is 400,000, in which we multiply 10% of the interest rate with the principal amount, 4 million. The tax base of the loan is the same as the carrying amount, which is 4 million. However, the tax base of the accrued interest is nil, 0. Okay, because as I already mentioned or explained earlier, okay, under the tax rule, okay, interest, in expenses, okay, including interest expense, will only allowable to be deducted for tax purpose if it is paid. Right, therefore, temporary difference on the accrued interest is Rm 400,000. D. An entity has recognized interest receivable on a fixed deposit of Rm 2,500 in its balance sheet. Okay, so how much is the tax base and how much is the temporary difference? Right, as interest received is taxed on cash basis, so the tax base will equal to nil, 0. Okay, so this gives rise to a temporary difference of Rm 2,500.